For cash basis taxpayers, timing is everything. You generally report income when you actually receive it. But the IRS won't let you delay tax just by not picking up the check. That's where constructive receipt comes in. On the EA exam, they love questions where the money is available before year end, even if you didn't physically touch it. Constructive receipt means income is taxable when it's credited to you or set aside for you, and you can draw on it with an unqualified demand. No real barriers. Also, if your agent receives it, you received it. So if your manager, attorney, or broker gets your money in December, you can't pretend it's next year's income. The big exception is substantial limitations or restrictions. If accessing the funds would cost you something meaningful, like giving up a legal right, that's a restriction. Think of condemnation proceeds deposited with the state. If withdrawing the money would jeopardize your lawsuit, you don't have constructive receipt yet. You report it when you can take it freely. Prizes and awards are another favorite exam trap. If you actually receive the prize, you're generally taxed at fair market value. But if you never receive it, you can't be taxed on it, like concert tickets that never arrive in time. And if you decline an award entirely, you avoided constructive receipt because nothing was made available to you without restriction. Now, switch gears to the claim of right doctrine. This is when you included income in a prior year because you had a right to it then, but later you have to repay it. The key exam threshold is $3,000. If the repayment is $3,000 or less, IRC 1341 doesn't apply, and you generally don't get the special tax-favorable calculation. If the repayment is over $3,000, IRC 1341 may let you choose the better of two outcomes. Take a deduction in the year you repay, or take a credit equal to the tax decrease you would have had if you never included the income. But watch the income type. If it was self-employment income from a business, you typically handle it on Schedule C by reducing income in the repayment year. Income is also not considered to have been constructively received. In which scenario? An employee gets a bonus in late December but waits to deposit it. Dividends are automatically reinvested in a mutual fund. A landlord gets rent in late December but waits to deposit the check. Or the taxpayer declines to accept an award. Think about it. Where is the money truly unavailable? The correct answer is, the taxpayer declines to accept an award. If you refuse it, it's not credited to you or made available on an unqualified demand, so there's no constructive receipt. The tempting wrong choice is the bonus or rent check you don't deposit. Because you still had the check and could cash it, that's constructive receipt in December. Which of the following would never be considered a taxable recovery? A rebate of an itemized deduction from last year, a state income tax refund, an insurance reimbursement, or a federal income tax refund. Think about the tax benefit rule. What was deductible in the first place? The correct answer is a federal income tax refund. Federal income taxes aren't deductible, so a refund can't be a recovery of a prior year deduction that gave you a tax benefit. A state income tax refund can be taxable if you itemized and got a benefit, which is why that option is so tempting on the exam.